Today, my guest is John Wilhoit. John is a returning guest to CREPN Radio. In previous episodes, we've talked about markets, assets, and big trends in real estate, and that we've always learned a lot, and looking forward to speaking with him again. He is an asset manager. He's a real estate investor, an author, and also most recently a podcast host. And today we're going to be talking with John about the rent roll triangle. But first, a quick reminder, if you like the show, CREPN Radio, please let us know. You can do this. You can leave a like, comment, share the show with somebody, or subscribe. And also, if you'd like, our YouTube channel is Commercial Real Estate Pro Network. You can, if you'd like, you can watch myself and the guests speak and get to know us a little bit better that way. So again, on YouTube, we're Commercial Real Estate Pro Network. Okay, now we are ready to welcome our guest today, John Wilhoit. John, welcome back to CREPN Radio.
Thank you. I haven't seen you for months in person.
Yeah, it's been just
by video, I should say.
Right. No, it's been a little while, and it's always a pleasure to see you and speak with you. And looking forward to talking again with you today. But before we jump into the topic today, if you do myself and listeners a favor and share a little bit about your background.
Sure. I've been in real estate, specifically asset management, institutional asset management for the majority of my career. My asset class of choice is multifamily. So that's where I focus most of my attention. My clients are coast to coast. In my employment history, I've worked for HUD. I've also worked for a publicly traded real estate investment trust, and also for institutional investors that focus on multifamily investments.
Got it. And today you've offered the topic, the rent roll triangle.
The rent roll triangle is the title of my latest book. It's my fifth book. My best-selling book is entitled How to Read a Rent Roll, which is all focused on rent roll analysis for the novice to the professional. In the last two chapters of that book, I brought forward an idea which I coined as the rent roll triangle. And that idea grew some legs, and the legs turned into the next book. And I have a copy here just so that people can kind of see what it looks like. It's very easy to find on Amazon or on johnwilhoit.com. But the book is really focused on income elasticity for income properties. And it's just another methodology for your consideration of what I call a back of the envelope calculation that gives people an idea of where the property is from an income perspective without having to go through a significant model. So if you're an institutional investor, you'll have anywhere from 2 to 10 models that you'll run a property through to get the skinny on what's going on, right? From income, market assessment, demographics, balance sheet, all of those things go into making a determination for an investor if they want to put down $10 million, $20 million, $30 million in a site somewhere in the US, as an example. Well, my book, Rent Roll Triangle, gives everyone from the institutional investor to the guy buying a duplex a quick and dirty singular calculation for determining strength of income for an income producing property. So it's not the be all end all. It shouldn't be used by itself exclusively, but it's another tool in your toolbox that you can bring out to see where a property sits on the buy side before you make the buy decision.
Got it. And before we get into the how to calculate that, would you tend to think that there would be like a range of acceptability, or kind of I guess as you use this tool, would you come to realize a certain range of the properties you're looking at and what you would expect, and be able to determine which property might be a better income generator versus another? Is that kind of what this would help us determine?
The best answer to that is to say no. And the reason I say that is because it's just like any investment that you buy when it comes to real estate investing, particularly for active real estate investors. It's not that you buy the deal, whatever the deal is. It's what you do with it once you buy it. So just having a number, percent, a calculation accomplished that says X doesn't really tell you anything, you the buyer. what that property is going to do going forward. It's a matter of addressing the property with appropriate financing, with solid management, with making sure that the business is run like a business, not like a mom and pop shop. And that's, again, whether it's a duplex or a 50,000 square foot office building. And if we have time, I have some case studies that we can go through that kind of reflect the differential on how assets are run and how that affects the calculation.
All right. Well, why don't we get into how to calculate the rent roll triangle?
Okay. All right. Simplistic. There's all types of income that people look at, from effective gross rent, gross potential rent, stated lease rent, and then there's this thing called collected rent. So although we have all these other calculations to determine an income figure on income property, at the end of the day, you only collect so much money, right? And that's a known fact. We may think we know what gross potential is. We think we know what we should be collecting based on what's stated in the leases, but invariably at the end of the day, all of those numbers are different. They are never at any point all exactly the same. And if they are, that's meaning that the stars have aligned and it's occurred for a minute. It's kind of like a Formula One race car driver. They think they've hit max, right, in terms of speed in the corner. And then you try a different set of tires and you get another 0.5%, in speed out of that car just by tinkering with one thing. So with the rent roll triangle, there's a lot of things to tinker with, but it's really an income elasticity tool. It gives you a percentage of gross potential that the property is earning presently. So what I mean by that is, if you have a property that should be generating $100,000 a year based on gross potential rent, and it's only generating $89,000, on the face of it, that means it's generating 89% of gross potential, right? So some people would say, oh, that's bad. Others would say, oh, that's pretty good. A high quality, long-standing operator is going to say, that means we have room for growth. There's some things that we can probably do to tick that number up a little bit. But surprisingly, a lot of properties are nowhere near their maximum potential. Some properties are in the 40, 50, and 60% of potential. But how do you know that? And how can you do it quickly without having to find a model, run the model, hope that the model is working well, hope that the model is valid, and then seeing kind of what comes out of it? Well, the shortcut version is use the rent roll triangle to get to that quick and dirty. And then from there, it identifies for you where you should focus in terms of income. So the shortest of versions on how to calculate rent roll triangle is to take gross potential rent. Start over. The quickest way to obtain the rent roll triangle number is to take collected rent and divide it by gross potential. So that is the simplest way. And that's where you'll come up with, oh, the property could be earning $100,000. It's earning $89,000. So therefore, it's at 89% of maximum rent potential. So that, again, doesn't tell you a lot. That is just an aggregate generic percent number. So what I've done with the rent roll triangle is take in those other aspects of quote unquote rent. So you need to know 4 things to provide a positive. You need to know 4 things to generate a quality rent roll triangle score. And that is the gross potential rent, the stated leases, what does it say in the leases that the rent should be, and the collected rent. And those are the 3 things that are at the top. And then the last thing is the term or the average term of tenancy. And it's different for office versus medical office versus warehouse versus multifamily, but there's still an average term of lease irrespective of what type of income property it is. So that's where we start at the high level.
Got it. And you made the point in the beginning about the benefit of this is to recognize if there's potential to improve the property, and I would think that would be a welcome number for anybody looking to buy a property, to recognize that, hey, look, there's money to be made here. How you mentioned 40 to 50%. Have you found properties regularly that are that are operating that low?
Yeah, let me just bring the last part of our conversation forward right now and use one of the case studies that I have, because
Okay.
we can't cover all the case studies. There's about, I think there's 8 to 10 in the book total, but it's a very short book. It's barely 100 pages, if that. But so I tried to make it as compact as possible. But one of the case studies reflects a duplex that's long-standing owned by some folks. So they've had it forever, and the residents that are there have been there forever. And, we can determine forever being 2 or 3 or 4 years, right? Not necessarily 20
Right.
years. So everyone's really comfortable, meaning the residents are comfortable, they pay their rent on time, the owners of the property are comfortable, they're not interested in doing anything to the property itself or raising the rents because they know they have good tenants in place, good residents in place. So it's all good, right?
Right.
Well, 5 years go by, and the property that was renting for $800 5 years ago is now renting for $1,000 because they have made, $40 rental increases every year for 5 years. So now we're sitting at $1,000, and then something happens on the ownership side that says that we need to sell this property. So we need to sell it for whatever reason. We've decided that this duplex is no longer something that we can continue to own. And then what's the next thing that an owner does? They try to get an opinion of value, right? They try to estimate what the value of the asset is. And there's different ways to do that. One is to get an appraisal. Another is to call some brokers that specialize in that area and get an estimate of value. And the first thing that the broker is going to tell you is it's as is sale price, quick sale price. And then they'll tell you a value if you decide to put money into the deal. If you decide to increase the capital expenditure, meaning write a check to get stuff done, whether it's a new roof, painting, driveways, water heater, expensive items that you would have to upgrade the property to make it more valuable. So in the example I use in the book for this duplex is the current rents, and I don't remember the exact number, but the current rents are $20,000 annually on the duplex. And the opinion of value for the property is $200,000 as it sits. However, if the owner were to put in $20,000 to improve the property and exclude or remove the existing tenants, the broker says to the owner, now that even though you're renting these for $800 to $1,000 a month now, if you were to do these improvements, rents would pop up to $1,600. Well, that means that the
1,600
owner,
per side.
1,600 per side. So that's just a reflection of an owner that hasn't been paying attention, right?
Right.
And that's fine. It's their deal. They own it. They can do anything they want with it. If they want to continue to rent it for $1,000 a month, they can do so. If they want to sell it for only $200,000, they can keep it as is. Or they can do the work, right? They can update the property, change out the residents, increase the value by bringing the existing rent up to current day gross potential. And that's a decision point for an owner. Some people say that's a no-brainer. I can't wait to do it. I love these guys that have been there for the last 5 years, but hey, $100,000, $100,000, I need to go get it. And another owner will say, you know what, we just need to sell it as is. I'm fine with that, which means they're leaving money on the table for the next person, right?
Right.
To upgrade the property, to replace the existing residents, to bring the upgrades into place. But if we were applying the rent roll triangle calculation to this property, that rental amount of $20,000 a year is likely substantially less than today's current rate if you haven't had rental increases that make sense or that are approaching gross potential. So I can tell you that my dad does this all the time, and he's about to be 80, and he has several rental properties, and he doesn't care a whole heck of a lot. Okay, so when it comes time for renewal, do you know what your rental increase is? It's $50.
Period.
That's just his number.
Yeah.
It doesn't matter if the place rents for $2,000 or $1,800 or $2,400. At the renewal, your increase is $50, and he goes about his business. And a lot of people do that.
Right.
And if you're comfortable with that, and it's all good for you, then God bless you. But change that to being a serious investor who's looking to maximize profits. You're going to want to know what your gross potential rent is every quarter, every year, and try to maximize rents to get somewhere close to that number on a consistent basis. So unless you perform the calculation, how do you know? How do you know what the disparity is between current rents and gross potential rents? And from an institutional investor's perspective, that's a daily occurrence for some people's shop. Others do it monthly, others do it quarterly. But for the vast majority of income property owners, it's really not on their radar screen that we need to look at gross potential, identify that against effective rent versus stated leases versus what we're actually collecting. So we can take that same duplex example and apply it to, and then you kind of plug in what you want there in terms of the property type, whether it's a small office building, a 5-story walk-up, a vacation home that you rent year-round because you intend to use it for vacation sometime in the future, but right now it's a rental. So the calculation can be applied to any property that's generating income.
Got it. So in the case with the duplex, the gross potential rents are essentially what the market's getting, right? I mean, you're looking at whatever,
Right.
like in your dad's situation where if he's only going up $50, but the market is $400 higher, you'd
Right.
use $400 higher rent for your gross potential, divide by what you're actually collecting, and get that ratio.
And you can see that there's a disparity between those two, right? And there's a perpetual disparity because gross potential is always changing, and it doesn't always go up.
Right.
So in that instance, if it's a seasonal property and the property's running for $1,500 a month all summer, doesn't mean if people are moving out in December that it's going to rent for $1,500 in January because it's a seasonal location. So recognizing what gross potential is, if you know that it's $1,200 a month if leases are starting in December, then you probably want to stay away from starting leases in December, right? If you can. But at least knowing what gross potential is would tell an owner, you know what, it's December. If I want this place rented, it's got to be for $1,200, as opposed to saying, well, I don't know why I can't rent this thing for $1,500. It's been rented that way forever.
Right.
You got to do the work. You have to do the research, and you can let it sit vacant because you're still asking $1,500 in December. Or you can say, you know what, I'm going to get this thing gone and occupied because I don't want to pay the utilities through the winter. We need to get some income going here.
Right. Well, and it seems like as an investor, somebody looking for additional properties, that this would really, I guess you could really determine the disparity easily, which is the beauty of the triangle.
Right.
In those mom and pop managed properties, it would be, I mean, it seems like that would be where it would measure. I think you would find the greatest disparity versus if you've got a professional management company in place that's constantly pushing the rents and on top of the game. This would definitely be that measuring stick that one could apply easily and go, wow, there's some opportunity here.
Yeah, and you'll see it mostly with the smaller properties, but even at the institutional level, there's always a difference. There's always a gap between gross potential, stated lease rents, what the leases say, and collected rent. There's always a gap between those three, and that's how the triangle comes to be in terms of telling you where to focus.
Wait. Say the triangle again. You said the state.
The three types of income that we're measuring against the lease term is the gross potential rent, and then the stated lease rent, which is what the leases say the rent should be, or what the leases should be collected, and then actual collections.
Gotcha.
So those are the three, and then what supports that is the lease term. And I'll tell you the lease term has a significant effect on that percentage output of rent roll triangle. So properties that have longer term leases have greater value than properties that have shorter term leases. That's pretty normal. I'm not talking about a 6-month summer lease or a 3-month summer lease, but I'm just talking about in terms of, particularly in multifamily, the turnover is about 50% per year across the national portfolio. So that's a lot of people moving every year, right? So if 50% of your units are turning over, that means you have significant turnover cost. So if there's something you can accomplish, there's something you can do as a manager to strengthen and lengthen those leases to 13 or 14 months, you've automatically decreased your turnover cost. So the triangle is supported by term of lease as a factor that tells you what's going on at the property and what your strength of income is. So from a multifamily perspective, the longer the term the lease, quality lease, then the higher the value of that lease because there's less turnover cost to the owner of the property. But let's look at those disparities between those three numbers. Okay, so let's just say that property A has a gross potential of $100,000 a year, and the stated leases are at $95,000 a year. So there's not much of a gap there, right? So
Right.
you think, great, the leases say what the leases say, and they are pretty close to gross potential. But then the next number is collections, and collections are $80,000. So even though we know that the leases look good and they are approaching gross potential, the rent roll triangle will tell us, hey, there's an issue here because we're only collecting $80,000.
Right.
So just by inputting those three numbers into the calculation, you'll see where you need to focus in terms of property management to address the issue at hand. And the issue at hand is collections are not approaching what we say we are getting, what we say we should be getting in terms of collected rent. We're not collecting 95,000, we're collecting 80,000. So we're really at only 80% of gross potential, and that's without going through the rest of the calculation.
Right. No, and just that reiteration of the difference between what the lease says versus what the actual collected
Yes.
is a great reminder there, and just making it simple, the three things to look at.
Right. But we're putting them all in one place with respect to utilizing the triangle.
Right.
And then just to solidify that what we're looking at is true and correct or has some validity to it, that's why I added the lease term component. Because if your leases are turning over every 6 months, 8 months, 9 months, you're having high collections activity, meaning low amount of revenue collected, then you already know where to focus. You need, a higher quality resident base to address the hemorrhaging, right?
Right. Now, and you bring up a good point that longer term, if you can go longer than 12, you increase your odds of reducing your turnover rate ratio there. So
let me tell you where there's a point of friction often that will occur if property management companies are utilizing the rent roll triangle to make these determinations. They will say to an owner, hey, this is the issue. We really do need to raise our profile. We need to raise the quality of residents if we are going to get closer to this gross potential rent. But Mr. and Mrs. Owner, to do that, we need to upgrade our units, and it's going to cost $3,500 per unit, and you have 30 units. So we need $100,000 from you to upgrade the unit so that we can remedy this issue. And Mr. and Mrs. Owner may say, no, not doing it. So they're not doing it. That means this issue is probably going to persist going forward. So even though you know what the remedy would be, doesn't necessarily mean that it's going to be implemented just because it's suggested or that the action requested of property management is going to be honored by ownership. So it can create some friction in that way because the owner is going to turn around and say, well, what can we do that doesn't cost any money? And that's where the property manager again says, I'm doing everything I know how to do, but that aqua colored carpet is just not flying. So we can take it out and we can sand the concrete and spruce it up, but I'm hoping you will let me put in some faux pas wood floors, but that's going to cost $1,700 per unit.
right.
Says, okay, we'll do a couple and see how it works. So the owner does a couple and it works, and the rents go up, and those units are rented to a higher quality resident that pays better. Then the owner may say, okay, well, let's do a couple of more. So it doesn't mean that because you've identified an issue that it's a miraculous immediate fix for what's in front of you to repair. It may still take money to accomplish that. So what I just said in that 35 unit example, it may take an owner 5 years to get there.
Right.
They may not be able to write a check. They may have to do it out of cash flow.
Right.
So,
but you're still, I think that again, as a tool, you're able to identify what the potential is.
Right. And the disparity between the other two income categories. So it tells you where to focus.
Well, but even just the one that I was kind of recognizing is the between the what your leases say and what you're actually collecting. If you've got a collection issue, if you're kind of lackadaisical on the
right
on, your rent collections,
it bubbles up to the surface real fast.
Yeah, you're going to see that.
That's right.
Yeah.
And then you going the other way, if something's happened in the marketplace, such as in the United States in the last few years, where employment gains have been significant, that's had a direct effect on rental increases. So if nobody's really looked at rental increases in their market for a while, that $1,200 unit may now be renting for $1,400,
right,
or $1,500. So it's good to know that and to act on it, because now even though I've got, let's say, good collections, and my collections are mirroring my stated lease rent, guess what? I've got 20% room to grow here that I can implement over time as leases renew.
No, this is really good stuff. And this is your newest book. You said The Rent Roll Triangle is the title there?
Released in 2018. It came out with How to Read a Rent Roll as just the last chapter misnomer of, hey, this is something I've been thinking on and doodling on. But as it gained more traction, I had to take the next step and turn it into its own book. And that happened just in 2018. So it's on Amazon now, thankfully. And I'm glad to have that one behind me, or in my notched on my belt, as they say. And we can go on to other things. But that has become a part of what I do with every client that I engage with. When we're looking at either a single property or a portfolio, the rent roll triangle calculation will be put to the test on each asset to see where they stand.
No, that's good stuff, and I think the thing I like most about it, it's easy to use and easy to recognize that potential, and allow you to focus and recognize if there's an operational issue, or just if there's a capital improvement needed, kind of thing, like you're saying there.
Yeah,
So,
and as a buyer, you can do the simplified version and get that number. And if you're looking at 5 properties in the same zip code, you can accomplish that number with the simplified to see where they stand on the surface, and maybe cut 1 or 2 properties from your list. And what I mean by that is, if there are 5 properties for sale in the same zip code, some of them may be fully valued because they're all hitting gross potential and they're doing those other things. Whereas the other 3, if you're a value add buyer, may be at that 50, 60, or 70% in terms of our RRT calculation. And those are the ones that you may want to focus on as a value add buyer, because you know that there's room to grow here, versus the 2 that are already fully valued because they're already at max rents.
right. No, that's good stuff. That's glad to have had you explain that to me, and I'm sure listeners will appreciate that as well. John, where can the listeners go to find out more and connect with you?
Well, thanks to my friend Jane Darren Gross, I did start a podcast in 2017, and it's finally gaining some traction now that I'm putting some time into it. And you did warn me that it would be a significant time commitment, and I'm learning that in real time.
Yeah.
John Wilhoit on Real Estate came out. I think we maybe have 25 or 30 episodes up so far. They're generally pretty short, 10 to 15 minutes. And it's me talking about different stuff related to real estate, not exclusively multifamily, but mostly multifamily. And then johnwilhoit.com is what I call my author website. So there I have a handful of free email courses if you want to grab those, and a list of the books that I've written. But in essence, they all just link directly to Amazon, because I don't try to stock them in such. But my primary business, I will tell you, in the last year has been focused more on real estate startups in the technology space. And that's been a lot of fun for me. As much as I love to work on acquisitions and work with operators, particularly merchant builders, I've focused more in my time on the startups. And these young guys, they know what they're doing on the technology front, but fortunately, they don't know as much as I know about the actual dirt, right? So they need a few old guys like you and me around to share with them how the property actually operates and where it connects with the technology that they're building. And that's been a learning curve for me. I think I'm keeping up with them, but we don't know yet. It's a fun ride though.
Well, it's kind of the old dog new tricks and the new
That's right.
dog's old tricks, right?
That's right. Yeah.
Yeah, that's good. That's
Yeah,
good.
it's a good match. It's a good match. So,
Got
but
it.
I'm getting to work with people all over the country again, and most of them are in their 20s and 30s. So they certainly do keep me on my toes. And the most interesting thing I would think that maybe your listeners would find interesting, particularly if you're over the age of 40, they don't have a work schedule. They do not have a 9 to 5 schedule. It is a 24-hour schedule. So I don't know when these guys sleep. I'm assuming they do sleep occasionally, but my email box will be full of emails at all hours of the day or night and weekend. So there's nothing compressed with what
Right.
they're trying to do, because they're all in a hurry to get to where they want to go. And they're trying to do it as rapidly as they can in the least amount of time as they can. So,
Yep. No, it's amazing what you can do on Red Bull and caffeine.
right. And I'm still looking, if I can get, a nap once in a week, I'm a happy camper.
Yeah.
But these guys living on Red Bull, no, I don't think they can spell nap.
Got it.
Not in their vernacular.
I got it. Well, John, thanks again for taking time to talk
Yes,
today.
Thanks for having me.
I've enjoyed it and learned a lot, and look forward to doing it again soon.
All right. Same time next year, if not sooner.
All right.
All right. Thank you.
And for our listeners, if you like the show, share it with someone you know. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.